What tax breaks can I get by purchasing a home?
You can deduct your home mortgage interest. You can deduct your real estate taxes. You want to look like you're profitable. If you are working, if you're a paid employee and you're getting a W-2 every year, once you buy the house, you know that you're going to be paying less taxes. And so you can adjust your withholding so that you have access to your money.
That's great advice.
Yeah, I need every bit of gain I can get.
Yeah.
Hello, everybody. How you doing today? Welcome to another episode of Homeschool. I'm Carlton Puckett, and my beautiful co-host to my left is...
Hi, guys. It's Romina Zamon-Por. Happy to be with you today.
And we have an absolute fantastic guest today. We have Mary DePaoli. She is going to be telling us everything that we need to know in reference to getting a home. She is a CPA, so she's going to tell us everything tax-wise and answer every last question you could ever possibly have in reference to taxes. Mary, thank you so much for coming in today.
Well, thank you so much for inviting me.
Now, let's get started right off the bat. Can you please tell us what is a CPA?
A CPA is a certified public accountant. They have to have a certain amount of education. They also have to pass the CPA exam, and they need to have certain hours of audit experience. So you get all of that, and then you are certified. Once you are certified, you also have to continue every 2 years updating your education and recertifying. So it's an ongoing process.
Okay, wow. So, of course, we've always heard about, you know what, you need to have a good accountant. And then you hear people say, hey, who's your CPA? Is an accountant and a CPA one and the same, or they're two separate things?
They can be the same thing. CPA just means that they have a title. If you're talking more taxes, you can even have people who are enrolled agents who are preparing tax returns and can give some tax advice. CPA is a broader title that talks about accounting, which would be recording the activity of a business, their general ledger, versus actually preparing tax returns too. So they can do both.
Okay. If you don't mind me asking, how long have you been a CPA?
Since before they used to use computers on engagements, I've been a CPA over 35 years.
Oh, wow.
That's amazing, Mary. Thank you again for joining us. Can you shed a little bit of light? Tell us about like pre-computer and post-computer accounting.
Oh my gosh. So when I started accounting, you would go out to clients to do their annual financial audit, which is not the same as a tax audit. And you would get a general ledger, which was a computer printout, and then we would analyze that information using pen and paper. And all of the audit adjustments would be rolled up manually into a trial balance, and then we would issue the financial statements. So it took a lot longer to do audits, and you also had to be on site at the clients to get to their records. Now a lot of this is done remotely, where I just send them a copy of a general ledger, and then they do the analysis that they have. So it goes a lot quicker and a lot shorter period of time.
Probably a lot easier now than I assume. Yeah.
Yes.
I was going to say, you have to really love math.
Yeah.
No, actually, when it comes to accounting, you don't have to be really good with math. You just have to be comfortable with numbers. I mean, I can add, subtract, and if it's an exciting day, multiply and divide. But it's just looking at numbers and do they make sense? And when you analyze something, is it giving you the answer that you want? If it's not, why is it not? That's more my forte. And so you don't have to be good at math. If you would look at me and say, can you add this up? I would be taking off my shoes and counting my toes. So.
Well, good to know I'm not the only person that still counts with my fingers and toes. I'll ask you this burning question. Speaking of numbers, what tax breaks can I get by purchasing a home?
Well, America is made for home ownership. The laws are geared towards that. You can deduct your home mortgage interest. You can deduct your real estate taxes. If you have a office in your home, you can be deducting some of your cost of your home as your office expense. It also, when you have those additional expenses, it makes your adjusted gross income lower, which could put you in a lower tax bracket, which means you're paying less taxes. But the non-financial part of it is you're also building an asset that is most likely going to grow. And we'll have something later on when you need to sell the asset, you'll have money to move on.
Now, something that's funny to me, because I guess we've all heard it. Of course, coming up, our parents always tell us, you need to get a house. You want to get a house. You don't want to rent forever. Mm-hmm. And that's always, especially in our field and in our line of work, there's something that always people renting versus buying. Let me ask the question. Once I purchase a home, how does that change my taxes? Is it good for me? Is it bad for me? Does it help me? Does it hurt me?
Well, when you purchase a home, you are investing in an asset, and the money that you are paying every month is helping build up your asset through your mortgage. And you're gaining something with more value, whereas if you're paying rent, that's just money out the door. You're never going to recover that. It's not going to come back. It is nice to have a landlord who will come fix things, because when you own a home, you are responsible for those things. But it's just, as I said, you're investing in your future when you have a home.
Are there any special programs or tax credits available specifically to the first-time home buyer?
That varies by region and cities, and that probably would be best to have that conversation with your real estate broker when you are looking at particular areas.
Something, and this is funny, I actually had a family member ask me a reference, hey, will I qualify for a mortgage? Or, what do I need to do that'll better my overall chances? And I always tell them that's probably something you'd better want to discuss with like your CPA or your accountant. I can't really tell you what you're going to do or how to better your chances. How you handle your finances is probably the better question. So what would you tell a person in that reference? Well,
it's like anything. If you're getting ready for a race or a competition you're going to be training for, you need to prep for it. You can't just show up and do it. And when you are interested in buying a home, you need to make sure that you're current on your taxes, that you've been filing your tax returns. You want to make sure your FICO score is greater than 620, ideally. You want to show that you are paying off your credit cards on a regular basis and not hitting the ceiling all the time. You also want to know what area you want to live in, because that will make a big difference on how much loan you'll need.
Outside of the loan, let's say I'm a first-time home buyer, just bought my first house, how much should I anticipate paying in property taxes?
Your property taxes is in general based on 1.5 or slightly less based on the value of the home. And it will increase slightly every year, but it's not increasing as the same rate as the selling price of the house, if that makes sense.
That makes perfect sense. Yeah. So each year I can anticipate my property taxes going up every year as my house appreciates?
Right. But it's a small amount. It's not going to be like, oh, well, I saw that my house is now worth $2.4 million, my property taxes is going to increase. It's been slowly increasing every single year that you've been owning the house. So it won't match to what the actual selling price of the house is. If that makes sense.
Now, with that being said, to kind of piggyback off what property tax wise, is it better for them to include their taxes and insurance in their monthly mortgage payment? Or would it be better for them just to pay it separately, pay it on their own?
Well, with property taxes, it's in California, it is due in 2 installments. One has to be paid by December. The other one has to be paid by April. And that sometimes takes people off of sync, because it's not like, oh, every 6 months you're paying taxes. If you're not used to that, and if you've been paying rent all this time, it might be better just to impound it. Then you don't have to think about it, and you don't have to save up to make that first installment payment in December, which is usually a financially tight money.
Oh, definitely. It's Christmas time.
Right.
Cuts into the Christmas shopping.
So if you think you have the discipline to do it, great, because then it means you're controlling your money until you pay it in for the property taxes. But if you just don't want to think about it, it's probably better just to impound it.
I understand that unless you're putting at least 20% down on the purchase of your home, you're mandated to keep an escrow account with the lender until you have that equity. Is that correct?
That is correct.
Okay.
So, okay. let's say they get the home, but you always hear so much about people buying and selling and buying and selling. So let's say a person actually gets a home and then they're ready to sell it and move on to another home. Is there something tax-wise they need to worry about after they sell the home? Is there a benefit to it, or is there a penalty they can face? How does that work? Are they tax liable for anything once they sell their homes?
They will allow you to sell. Well, you can sell your home no matter when, but if you want to get the homeowners gain exclusion, for single it would be $250,000. If you're married filing jointly, it's $500,000 gain that's excluded from the sale of your house. You have to have occupied the house 2 years of the last 5 years you've owned the house. So you can't just buy a house, move away, come back in 2 years and go, okay, I'm selling it and I'm going to get this capital gain exclusion. You only qualified if you've owned the house for 5 years and occupied the house for 2 of those 5 years.
Is that only the case on the first home you buy, or is that any home that you purchase in the future? Okay.
And that's something we always, a question for myself, something I always hear about is capital gains. Capital gains a good thing or a bad thing?
It's a good thing. It's typically, whatever the current law is, it's done at a more favorable rate than the regular tax rate. You get a benefit from that.
What would you say, if anything, what is some advice that you would give like our first time home buyers? Because of course, this show is all about asking the hard questions, or the questions that people have. So if you just had an opportunity to tell like a first time home buyer, what is the best advice you would give them?
Well, I think it's once you've qualified and you've purchased the house, you have to realize you're going to still be spending money. It's not like, okay, we're set, we don't ever have to spend money again. You're going to have home improvements. You've got maintenance of the house. There's utilities that you have to pay. There could be an HOA in our homeowners association that you have to pay into. Just kind of general. You want to make sure that you have enough that you can maintain paying the mortgage and maintain your most valuable asset.
Because you're the landlord now. No one's going to come fix things up for you. You have to keep the upkeep of the home.
Well, a lot of homes, when they sell, the seller will provide a home warranty, and that's usually good for a year. So you just hope that, well, you don't hope anything breaks, but if that toilet breaks, make sure it's in the first year that you're on, so you're under the warranty to get it repaired.
You just spoke to like the aftermath for first-time home buyers once they've, purchased the home, the upkeep and kind of the expenses that they can anticipate after. How would you speak to a first-time home buyer looking to qualify for a loan in terms of like documents, or just being better prepared for the pre-approval and going through the process with the lender?
I would say you have to know what your financial position is. You have to look at make sure that you're current on your tax return and paying your taxes is very important. You have to make sure that you're controlling your debt with your credit cards. You have to show that you're a financially responsible person.
What advice would you give our self-employed borrowers? Our self-employed borrowers that want to purchase a home. Of course, we see it on our end, and it's always a bit of a task to when we deal with our self-employed borrowers in reference to their taxes. Please, can you tell our viewers what is the best practices for our self-employed borrowers when they want to purchase a home?
Well, you have to think about it from the lender's point of view. They want someone who's going to be profitable. So if you are filing a Schedule C with your tax return and you're showing a big loss, that doesn't really show financial stability. I think I'm not saying to cook the books or anything like that, but there's a saying in accounting, pigs get fat, hogs get slaughtered. If you know that you're going to be wanting to look for buying a house, you might want to be a little less aggressive on your deductions. Not that I'm saying to do anything fraudulent, but you keep that in mind. Just keep that in mind.
So nicely put. If you make $300,000 a year and you write everything off and now you're negative $27,000, don't yell at us when we tell you we can't qualify you because you don't make enough money. It's not our fault.
Yeah.
No, that's very true. That's very true. You have to look at it from the other person's point of view or the business's point of view. Would you lend someone who's in the hole every single year?
Another thing that I think is super common that we see when a first-time home buyer, specifically self-employed, comes to qualify for the loan, it's if they haven't filed their personal business returns for several years at a time, like, oh, I haven't filed since 2021. Well, the lender also looks at that and says, hey, we can't use your income of, 3 years ago to qualify. So just making sure they're up to date on those documents, I think, is huge, just to show current income.
Yes.
Yeah.
Well, the government is very, very thorough about making sure that if you have income and it's been recorded with a 1099, they will be tracking you down eventually. And if you don't pay, they will put a lien on your bank accounts.
You read my mind. That was actually going to be my next question for you, of what happens when someone's not up to date on their taxes and how does that impact them as a homeowner? And you answered that. There's a lien.
They will put a lien on your bank account.
Money.
They will get their money. Yeah. So just bite the bullet. Get it done. If you can't pay it, you can apply to get installment payments to the IRS and the Franchise Tax Board or whatever taxing entity you have. But it's better to stay on top of it rather than always be paying in arrears.
That leads me to my last question. What are the best tax strategies that a person should put into place if their intent is to purchase a home one day?
Well, you want to look like you're profitable. If you are working, if you're a paid employee and you're getting a W-2 every year, once you buy the house, you know that you're going to be paying less taxes. And so you can adjust your withholding. Again, don't be greedy, so that you have access to your money and you're not getting a big refund when you have your taxes prepared. When you get a big refund when your taxes prepared, that means the government had your money through the year and you didn't. So that's when it's really helpful to have your enrolled agent, tax preparer, or CPA give a projection. Okay, based on it, this is how much my mortgage interest is and my tax situation. How much should I be paying in? And then you can adjust your withholding. And then you might have to end up maybe paying a little bit, or you might get a little bit back. So that's what I would recommend.
Are things like closing costs for a purchase or a refinance things that will help me on my taxes? Are those things that are deductible that I would be able to write off?
Unfortunately, probably not.
Okay.
Some of them are, some of them aren't. I'd have to have the escrow statement in front of me to do that. But it's just an additional fee that you're going to use in purchasing your home. It's not going to be recurring once you are in the home and paying the mortgage.
Gotcha.
So I do have another question. Now, of course, we've beat up on our self-employed borrowers enough. We've let all of our borrowers know that they need to maintain their taxes and everything else. Now, let's say, for instance, once I do get into a home, is there anything else document-wise that I need to maintain? Or should I'm good now?
No, there are documents that you need to keep. Once you buy the home, make a copy of that escrow statement, scan it, file it, put it away. And then anytime you have significant improvements on your home, like hardscape, if it's something you can go out and kick, then I would keep those documents, because that adds to the basis of your home, which is important. When you sell your home, the higher your basis is, the lower your gain is. And you get a benefit for that. So it's really, really important. Also, if anything goes wrong with any of those improvements, you want to be able to look up the vendor or what was the warranty, and you will have it all in one location.
I am texting my wife as soon as we get out of here.
That's great advice.
Yeah, I need every bit of gain I can get.
Yeah. Well, you want to reduce your gain.
Yeah.
But also, if a crack happens in the sidewalk that they put in, do you remember who you paid? Oh, I don't know. Okay, you can pull up those documents and you can see and look it up. Also, very important, what was the warranty you had on that work?
Mary, you are absolutely amazing. Truly. I mean, these are always the questions I know for myself that I've had, and I know our viewers, if they have, and you have literally answered everything. I feel like we've been interrogating you. I am so sorry. Thank you again for joining us for another episode of Homeschool. I'm Carlton Puckett.
I'm Romina Zamon-Por.
And we have Mary DePaoli. Once again, thank you so much for coming.
You're so welcome, and I can't wait to see everyone in their new homes.
And don't forget, if we learned anything today from our wonderful CPA Mary, pigs get fat, hogs get slaughtered.
Sorry to our vegans.